Hello and welcome everyone. I have been working on a very important video here that I promised for multiple days now to take a look at the best long-term strategy for our Tesla investments. So as you know, we are going through a lot of turmoil right now and people are very nervous and they're wondering when does the dropping stop? What is about this whole bloodbath in the Max 7, in tech stocks in general, and now even in the NASDAQ as a whole. And of course, I know this is very disturbing to for a lot of you who are maybe new to this, but even to the veterans here, what is going on and how can we as a group, as people who understand and believe in the future of Tesla, of robotics, of AI, make sure we are taking advantage of the market weakness, but also long-term, make the right strategic decisions how we approach this investment opportunity. So before I start, I will do some disclaimers here. None of this is investment advice, obviously. We are just looking at that as a group, and I'm sharing some of my ideas. So please make sure you understand your own risk return profile, what you want, and so on. Also, this is not gambling. Very important. I see a lot of you like talking about options, call options, going long calls and all kinds of stuff. I have never seen anyone making money with options trading, to be completely frank. I know these people exist, but when I tried it, when I saw people doing it, you always lose money compared to actually just buying the stock and holding it. Now, there are some exceptions. As you know, I do some alpha churn strategies where I'm selling puts, but I'm very cautious about that. As you guys know, I'm sharing my approach sometimes. And there are also times where this is not very smart when you have high volatility right now, and you have to make sure you're really going way out of the money and all kinds of things. And this is just a tiny little piece of the strategy. So there's one exception that I want to talk about in this video about the strategy. And these are leap call options because they come close to a buy and hold strategy. These are not options trading strategies. They're more strategic investment tools. And before we go into the tactics and the tools, I want to reiterate one more time why it is we are so bullish on Tesla and why it is that I believe this is a once in a lifetime opportunity. I will be very brief because you guys already know a lot of these things. But we are living through what I call the AI singularity. The robots are not coming. The robots are already here behind closed doors in the R&D labs. The one company that has by far the biggest R&D budget, by far the largest amounts of cash that can pour into embodied AI, into humanoid robots, and to a lesser extent, robotaxi and autonomous transport, which is bigger than people understand because it can replace everything, including buses and taxis and everything, and cars. But the biggest company in the world by an enormous distance doing this is Tesla. So Tesla is a very unique combination of behaving like a startup, being as aggressive and as return and world-changing oriented as a startup, while having a massive 100 billion supporting it and over 10 billion in EBIT, right? That they can invest in all kinds of things like this. They're also led by Elon Musk. And, some people say, oh, Elon is a total genius and he's like, whatever. I think it's very simple what Elon is. Elon is someone who runs a giant company or multiple, but at the same time has retained the startup mentality. He sees opportunities, he sees new opportunities like the robots and jumps on them as if it would be a startup, but backed with tens of billions of dollars that he actually generates through his companies. And that makes Tesla very exceptional and different. I think there are some other Max 7 companies that have leaders that are very smart. I think Zuck, is actually close to getting closer to Elon. He's getting more aggressive and he does some very interesting things. I think Jensen Huang of NVIDIA still is very strong in his entrepreneurial ambitions. And so Elon is not the only one, but Elon has nailed it the most. Okay, so what does it all mean? What we also know is the DCF model that I'm sharing from time to time. I have a firm price target with a 10-year discounted cash flow forward-looking model of roughly 11,000 by 2030. That is basically the translation of what I just said into a concrete model and concrete quantification of the opportunity. Now, that creates the red line, the reference line that I started to share, where we can break down that price target and break it down into years and monthly price targets that help us to understand where the fair future value of Tesla actually is. And I just did a video on that. And that helps us to understand, are we underpriced or overpriced? Of course, right now we are ridiculously underpriced. And so that is our real alpha here as investors. And I want to go into that a little deeper right now. To have alpha means that you have an edge over the normal investor, over Wall Street and normal retail investors. And when we come up now with the strategy, what we do with that knowledge, it is very important to have a real come to Jesus or whoever moment. What is our real alpha and what is it not? And I split that alpha into seeing the future and then certain time frames where we know more than most other people. We do not know more. We do not have good alpha on a, sub 12 months time horizon, because it's very hard to predict the markets. There are people who try to do that. Tesla is a function of the market short term, as we see now, right? NASDAQ drops, Tesla drops more. And you can be the most ingenious person ever. If there's a market crash or correction, as we see it now, you're just going to see the stock drop. So to try to predict the next week or the next month or the next 6 months even is a fool's game unless you have major resources that are then kept behind closed doors. So this is not great alpha. If you want me to predict the next week, of course, we think about it, I comment on it, but if you want an edge over everyone else, that's not going to happen. Long term, 5 years, do we have an edge? Well, a lot of people who are smart analysts come out with very similar price targets that I have right now. I think 5 years is also not the biggest edge. I think we have an edge over 90, 95, 98% of people. But the 2%, which is still a lot of people, they understand all that stuff I'm saying. And they have their own models that show similar things. So the 11,000, I think many models show less. They don't price Optimus in, which makes no sense. But I also think 5 years, we have some edge, but it's not the biggest edge. I think the magic edge here for us lies actually in a 12 to 24 months time frame. And I will go into that right now. Why? In 24 months, you basically can translate your strategic insight into Tesla into Optimus launch, for example, and have high conviction that Optimus is going to launch in the next 24 months. Now, most people don't understand that. They think, oh, sure, in 5 years, we have all these millions of robots, but it's not going to happen now. So people are more wrong on a 24-month scale, and all of Wall Street, the institutional investors, are very uninterested in 24 months. They're interested in 12 months or less for many reasons. But no one really spends a lot of time thinking about 24 months. It's very important to carve out the alpha, because once you have your alpha, you know where people are most wrong, and you want to be as short-term as possible and as long-term as necessary to have maximum alpha. So 5 years is easy, but 24 months, I think, is a reasonable time frame right now to really know what's going on, where most people don't pay attention, are probably wrong about it. Okay, so let's go into the tools that we have to do something about this and the actual tactical investment strategies. I always say, if you want to know what buy and hold means and who does it right, look at Peggy, the curious Peggy. I'm on his YouTube sometimes, but Peggy is this person who's very deliberate. He has 1,100 Tesla shares right now, and you can see on his Twitter every other week he says bought another 3 shares. So Peggy is like unapologetically a buy, hold, and DCA investor. He just keeps buying and he does nothing else. That strategy, I think, is the second best strategy you can have. Because if it works, Peggy is going to make 3,600% on his investments in 5 years, which is pretty good. Extremely low risk. But the only con to that is, well, this is the reference benchmark portfolio, right? 100% Tesla, that's our benchmark portfolio, and you don't have alpha over that portfolio. So yeah, all your money in Tesla, DCA in, you will have the same returns as Peggy, and he's the frame of reference here because he's so concentrated on it. He even does videos on it. Now, we, of course, want to try to be better than that, which is very dangerous, by the way. It's very easy to be worse than that. So Peggy does a very good job, and he's a great example if you want to just sleep at night, easy. Now, there is something called leaps, and I got a lot of questions on leaps. So I want to go into leaps, and I'm going to do this by sharing and explaining a little model with you guys. And that model will show you some math around leaps that is quite interesting. So here we have the model. And I'm going to go into the leaps. And here's just one example. Sorry if this looks a little complicated. One example, just very briefly, so you understand how this works. So first of all, this is a scenario model. You can ignore this up here a little bit, but here basically you have my minimum share price. Right now it's 262, shockingly today. And here's my scenario share price over this year. And this is one scenario where basically the Robotaxi launch works pretty well. The stock market recovers, everything is fine. So it's a kind of a best scenario situation. Doesn't matter, it's just for illustrative purposes here. And you see, here's the share price. Here's what I assume happens on Robotaxi. Here's what I assume happens on affordable models. And here's what I assume happens to the market. I don't want to go into that too much, but I assume here Robotaxi launches is a great success. Everyone is happy. Affordable models launch in June, and share price in April gets confirmed that this actually all happened. So shares go back up to 350 in April. In June, it launches, goes to 400, then goes to 500, 600. In August, because we see Uber gets crushed in Austin, Robotaxi launches, everything is great. So I don't want to discuss if that actually happens or not, but this is an assumption right now in this specific scenario. Now, if you go down here and you see the stock move, the stock moves up in this scenario, 88 from where it is now. It moves up 138 from where it is now, right? And up to 500 and 600. Here you see the change in your portfolio if you would be 100% invested in Tesla. If you go 100% in now, and this actually happens, which might not happen, just full disclosure, but let's assume you're making 33% on your money. You go in with 100K, you make 33,000. By June, you make 52,000. By July, you make 90,000 in aggregate, right? And by August, you make $128,000. So you started with 100,000. Here you would have 228,000. Not bad. You would have made 128% gain. But now I will go into this in a second, why I think this is a very smart strategy. If you buy leaps, so what are leaps? Leaps are long-running call options. And I will only focus on one leap here, the December 26, 900 strike price leap. So this is a call option that expires in December 2026. So a long time from now, right? 2 months from now, nearly 2 years. It is worth something if the stock is above 900. So it gives you the right to buy the stock at 900. So you need to hit 900, but only then back all the way in end of 2026. And it has a delta currently of 0.21. We'll go into this in a second. And it costs you $20. So what does it all mean? It costs you $20. So basically, if by December 26, Tesla is above 920, oh, by the way, it doesn't cost $20. It's already down now, but it's probably 18 or something. If Tesla is $920 by December 26, this thing is worth exactly $20, right? You get the difference between Tesla's share price and at the expiration and the strike price. So Tesla has to go to $920 in order for this to be worth something. Now the delta means, this delta is something very complicated. I will explain it in a second. Delta means if the stock currently goes up $1, how much does this price go up? And currently it's roughly at 20%, 0.21. Which means if Tesla goes up 1, this thing goes up 20 cents, which is actually a lot when you think about it, because it only costs you $20. This delta changes all the time. That's the complicated thing about delta. So if Tesla goes up more, right, this delta actually goes up. Because you can imagine if Tesla would be at 900 or something, this goes more, approximates more and more 1. Because at some point, if you're deep in the money, it just goes up the same. But for now, it's 21. 0.21, and that allows us to calculate what happens if the share price goes up. For example, right? For example, if the share price goes up dollars, like in April, this thing goes up to $38 total price, right? You can calculate this in a simple formula. So that allows us to simulate a little bit what happens to your money. As you see, and then I calculate the percentage, this over this. So if instead of having bought one share, you would have bought whatever, like 20, 12 or 15 of these things, you would be up this much. And so look at this, right? If instead of shares, you would invest in leaps, you would make by August, or let's say by July, not 89%, but you would have made 238%. So leaps are basically a way of getting leverage on your capital. And the good news about leaps is you're not under that much time pressure as normally with calls, because they are so long running. So all these metrics actually don't change too much, and you're not losing too much money with time going by. So let me know in the comments, join the group on X, and ask all your questions about this. I have to get a feel who knows what about options. I can go into that more, but you can read up yourself on it. Now, what does it all mean? If we take this strategy, we can actually do something very smart. We are in the situation that if you are invested 100% in Tesla shares right now, then you see your share price drop like crazy. It goes from 480 to whatever it is now, 260, 270. That is pretty disturbing. If you're a long-term investor, you don't care too much because you know it's going to 11,000. Who cares if it drops from 480 to 200 if it ends up at 11,000 either way? That's why you can sleep well if you are 100% invested in Tesla long-term and do not have to take your money out. If you're on margin, you can't sleep because you get squeezed out. It falls to 200. You have to sell all your stocks. It goes to 11,000, but you're broke because you couldn't keep your stocks. One of the biggest things is that people say after these giant drops that we just experienced, and it can get worse, by the way, they say, I wish I had money. I wish I could just buy more here because it's free money. But you can't because you don't have money, because you are 100% invested in Tesla. And if you think you're smart, and you're starting to sell Tesla to generate cash to have dry powder, how do you know that Tesla doesn't just go up in the market? And then you sit on your dry powder, you make less money because you're not fully invested. That is the old problem with all kinds of tactics. And that's why Peggy is one of the big winners in this strategy, because he just keeps doubling down, investing everything, and then you always win as long as you're right long term. But now with the leaps, we can start becoming a little bit more aggressive. We have to be smart. We have to be right. We have to time the market. And you know that everyone says this is impossible. But I tell you, timing the market becomes exponentially more possible if you do it long term. If you do it long term, right? For example, right now, we know Tesla is very cheap. We know it's very cheap. At 480 in December, I guaranteed everyone we will see lower prices at some point, which is all you need to know. So let's take a look at the leap scenario and how this can be so powerful. Now pay real attention, because this is important for the group, for us as reality engineers, and for us as people who want to generate alpha over Peggy. Peggy is our reference. We need to beat Peggy, not because Peggy is weak, but because Peggy is strong. Peggy will win. It's very hard to beat Peggy. With Peggy, I mean buy and hold. So here's my approach to try to achieve that, besides my alpha churn strategy that I share from time to time, which is a tiny strategy. Okay, let's assume we have a share price of 285 or whatever. You can like change it to the current. And the leap price right now is $18 roughly, right? And here's our reference stock portfolio. So here's basically the Peggy portfolio, right? You are 100% invested in shares. And, you know, here I'm just assuming you have a total value of 246,000. Now here's our alpha portfolio where we are leveraging leaps. And the total value is also 246,000. So we start at 100%. Both have the same amount of money. But in this portfolio, because we are already so low, we decide, you know what, we only want to have $800 in shares. And we want to have some leaps here. And we have 10 leaps and 800 shares. And these 800 shares are worth this, right? So you basically multiply just this number with this number, the price with this number. So we have 228,000 shares, whereas this portfolio has 246,000 shares. But this portfolio also has 18,000 in leaps. Okay? So instead of being fully invested in shares, we are also invested in leaps. Now, very interesting. Let's assume by April 30th, the stock has dropped even more, because that can definitely happen. Imagine there's an earnings call. Imagine they delay Robotaxi or some disaster, and then it's going to drop more. Doesn't matter. Let's assume it drops more. Now, we see it drops more, And this is our new portfolio. So this portfolio has 194,000 now. It drops 50,000. We drop more because we have these leaps that kill us more. So we have some of the leaps, we lose more. And that's how it looks like. The leaps are then a smaller share of the portfolio because they lost more. Now we reposition because we're smart. We reposition and say, wait a moment, 225, are you completely kidding me? This is ridiculous. I wish I had more money. Guess what? We have more money now, more or less, because we can shift shares into leaps. So we take our 800 and shift out of shares for 300. So we reduce our shares to 500, right? So our new thing goes down from 180,000 in shares to 112,000. And we take all the money and we buy leaps. We go from 10 leaps to 112 because now they only cost $6.63. And that's very interesting. Now what happens? August 15th, Robotaxi actually launches. Things look good. Goes to 450. Just assume, right? So this doesn't matter where it goes up. But here in the scenario, 450. Now what happens? Well, what happens is we make massively more money because our leaps are kind of an indirect leverage. And so when you look at that, the shifting of stocks into leaps, what it does to the portfolio is now we have a differential that is pretty massive, right? So the reference 100% stock portfolio is at 388,000 bucks, but ours is at 521,000. Guess what? That's pretty good. We absolutely crushed it and outperformed that stock portfolio massively with the same amount of capital. Now we are smart and we know leaps, we need to be cautious. So what we're actually doing is we increase the stocks now. And you see, we generate real alpha. We have now over 1,000 shares. We are basically going from 500 stocks to 1,100 shares, right? Money isn't being touched. It's just being transferred from shares. And that means we have to go down to 10 from 112. So this is all automated math. So that's how it would look like. Now let's assume November 15th, we see a bad second half, market crashes, Tesla drops to 350. Okay, this stock portfolio would go down proportionally, right? It basically goes down to 302,000. And what happens to our portfolio? Well, we are going down to 393,000 from 521,000. So that's the new situation. But guess after the drop, even after the drop, we are nearly $100,000 bigger than that portfolio. I mean, that assumes that we are smart in getting rid of the leaps here. You have to basically transition out of these leaps and you want to be in neutral mode or in stock mode as quickly as possible if you have a big run up. But if you see a crazy drop, you double down. And then from here, you would shift back into leaps, right? If you believe it's relatively low, but 350 end of this year would be very low. So then you're reducing your stocks again. And now look at this. We are basically buying leaps again. We are going from 10 to 168. So you know where this is going. This is basically a strategy where instead of being just frustrated when the stock drops and frustrated that we don't have more capital, we generate synthetic dry powder. Synthetic dry powder means we're shifting from stocks into leaps to have a 3x leverage roughly. And when it runs up, we transition out back into stocks. Not much can go wrong with that strategy if we are smart in timing it, if we don't do it too frequently, and if we just make sure every time we do it, we are right. How are you right about it? Well, if you buy leaps and increase your position of leaps, you need to get out of them at a higher price, not a lower price. If you get out of them and transition back into stocks at a lower price, you lost. And you have leveraged down. So when we shift into leaps, we need to be 100% sure that we can get out of them within the next 12 months at a higher stock price. That's the advantage of leaps. You have a lot of time. Even if a year goes by, the leaps are not going to drop too dramatically if nothing happens, right? That's the good news about leaps. Leaps, what I mean with leaps is at least 18 months to expiration, should be longer than that, ideally over 21 months. And then you have this wait time in case you are wrong, and wrong again, you're still not losing money because you have the time to wait. At 225, it's just basically guaranteed if the world doesn't end that the stock price will be higher. At 285, it's guaranteed that, in my opinion, that the stock will be higher. At 350 end of this year, it will, this is a no-brainer. As long as you have time to wait. As long as you don't have to freak out if it drops to whatever, way more. So I hope this was like a helpful insight into the strategy. I call it synthetic dry powder. Create a synthetic framework that allows you to be 100% invested in Tesla. But if some bad shit happens, you can transition into a leveraged position and basically generate dry powder synthetically without having capital left. So I think this strategy, if done right, if we pay full attention, is going to generate massive alpha without taking too much risks. The only thing I'm going to add later to it is my alpha churn strategy. I just like it because it generates monthly income, but you have to be cautious. Easy to lose money on that if you do it wrong. So that is my take. That's why it took me so long to actually share this with you guys. I had to contemplate a little bit, how we do this, but I'm pretty sure this is a good strategy, especially in this bad market right now, because on Friday, I said I'm getting into 40%. I'm taking 40% off the table. I was invested 110% on Thursday. Then I got out. I was invested 70%, but I put all of that stuff into more short-term calls. I shouldn't have done that, but then I made very good alpha on Friday, and then it hit me on Monday, and I was like super pissed about it. So basically all my alpha from Friday went away, and I had to contemplate more. I was like, what the hell am I doing here? I have my investment philosophy. I need to clarify this a little bit. And I think we need to get out of these tactical options trades. They're just horrible. They never make me money, right? They make me money short term, but you always lose what you made. With these long-term strategies, I never went wrong. I was always right. That's my track record. I was always right long-term, but short-term, I never can generate real alpha. I got just sucked into it a little bit. So I want to re-clarify us and put us on the right trajectory. We need to be long-term investors who understand what our alpha is. We understand Tesla and Elon better than everyone else. We understand the AI singularity and the robots better than everyone else. We understand that we have to become reality engineers and shape the world. And we start with level 1, predict reality accurately and translate it into alpha, into massive alpha over the stock market, and even over alpha, into alpha over Tesla 100% core position. And I think the leap and synthetic dry powder strategy, if you want to take it to the next level, you can add the alpha churn that I explained before in different videos, but be cautious. I think we are well positioned here to crush it if we do that. It's important to check in weekly or more than weekly with the group on X. Join it in the description. Our mission is to pool our intelligence, predict stuff better, so we have more confidence and more intelligence to know how much undervalued Tesla is at what point in time and what medium short-term things we expect, so we can place these leap bets accordingly. And we can also exchange our information, what the percentage is in the portfolio that is in leaps versus stocks. And I hope that was helpful. I will refine this a little bit more with you guys. Let me know what you think in the comments and on X. Join the group and we go from there. See you very soon.